You know what most people think kills real estate deals? Price negotiations, bad tenants, interest rates. But in today's market, there's something far more silent, far more aggressive, and almost nobody is preparing for it. Insurance. Not flashy, not exciting, but quietly, it's becoming the deal killer nobody budgets for. Let's break this down like real investors talk, not textbook theory. Picture this. A small duplex in a growing suburban area. Nothing fancy. 2 units. Solid bones. Rents are decent. Numbers look clean on paper. An investor runs the math. Purchase price, $420,000. Monthly rent, $3,200. Mortgage, manageable. Cash flow, positive. On paper, it's a yes. Underwritten, approved, ready to close. Then something changes. Late in the process, the insurance quote comes back. And instead of the expected $2,400 per year, it's $6,800. First, it looks like a mistake, but it's not. It's updated risk pricing, weather exposure, regional claims history, replacement cost adjustments, new underwriting models that factor in things most investors never even think about. Now let's pause here, because this is where most deals quietly start dying. That extra insurance cost doesn't just reduce profit. It changes the entire deal structure. Suddenly, cash flow drops from positive to almost zero. Debt coverage ratio tightens. The lender starts asking uncomfortable questions. And the investor, they're forced into a decision they didn't expect. Walk away or overpay for a deal that no longer makes sense. This is happening more often than people admit. And it's not just small deals. Let's go deeper. A mid-size investor I came across recently was scaling a portfolio in the Southeast US. Nothing extreme, just a steady build strategy by renovate, refinance, repeat. They had a 4-property bundle under contract. The plan was simple. Refi after stabilization, pull out equity, reinvest into the next cycle, classic strategy. But insurance changed everything. One of the properties, just one, had a history of water damage claims from years ago. Nothing recent, nothing severe. But the new insurance provider didn't care about history context. They priced risk based on data models. Result? Insurance on that single property came in 220% higher than projected. Now here's where psychology kicks in. Because the investor didn't lose money immediately. They lost certainty, and that's what actually kills deals. The spreadsheet no longer feels reliable. The return projections feel optimistic instead of realistic. And suddenly, every other property in the bundle gets reevaluated with suspicion. One insurance quote didn't just affect one deal, it started a chain reaction of doubt across the entire portfolio decision. They renegotiated. Seller pushed back. Timelines stretched. Financing window started tightening. And eventually, the bundle fell apart. Not because of price, not because of location, but because insurance reshaped the risk narrative. Now let's zoom out for a second. This isn't an isolated issue. Across the US, UK, and even parts of Australia, insurance costs are quietly becoming one of the fastest growing expenses in real estate underwriting. And here's the part most beginner investors completely miss. Insurance doesn't scale linearly with rent. It scales with risk perception. So while rents might go up 5 to 10% per year, insurance can jump 30%, 50%, sometimes even double in certain zones. And it doesn't announce itself early in the deal. It shows up late, after inspections, after negotiations, after emotional commitment, which is exactly why it's so powerful. Because by the time investors see it, they've already mentally closed the deal. That's where bad decisions get made. Overpaying just to make it work, accepting tighter margins, ignoring long-term risk compression. And that's how portfolios slowly get squeezed without anyone noticing in real time. There's also another layer here most people ignore. Lenders are adjusting too. If insurance premiums rise, monthly holding costs increase. That means debt coverage ratios get tighter even if rent stays stable. So even good deals start failing underwriting tests they would have passed a year ago. This is why some investors are saying something feels different in the market, even when prices look normal. It's not just rates. It's not just supply. It's the hidden layer underneath everything. Operating costs silently rising while valuations lag behind. And here's where it gets interesting, because experienced investors are not reacting emotionally. They're recalibrating. They're building insurance projections before offers. They're stress testing deals with worst-case premiums. They're walking away faster when risk pricing doesn't align. Meanwhile, newer investors are still shocked at closing tables, still assuming insurance is a fixed, predictable line item. It's not anymore. It's a moving variable. And in many cases, the variable that decides whether a deal lives or dies. So when people ask what's really changing in real estate right now, it's not just rates. It's not just prices. It's the silent repricing of risk itself. And insurance is sitting right at the center of it. And this is where things get even more uncomfortable for investors, because insurance doesn't just increase costs once. It often reprices the entire investment timeline. Let's go back to that duplex idea from earlier. On paper, the deal looked solid. But after insurance jumped, the investor tried to adjust around it. Maybe increase rent a little. Maybe reduce renovation scope. Maybe negotiate a slightly better rate with another insurer. But here's the reality most people discover too late. You can't optimize your way out of structural cost increases. You either absorb them, or the deal stops working. Now let's put real numbers on this so you can feel the impact clearly. Original projection. Purchase price, $420,000. Rent, $3,200 per month. Insurance, $2,400 per year. Net annual cash flow, around $6,800 positive. After insurance repricing, insurance jumps to $6,800 per year. Cash flow drops by roughly $4,400 annually. That doesn't sound massive at first glance. But in real estate math, that's the difference between a deal that survives refinancing and a deal that fails lender stress tests, because lenders don't care about your optimism. They care about ratios. Debt service coverage ratio, DSCR, tightens instantly. And when DSCR drops below threshold, everything slows down. Approval delays, higher down payment requirements, repricing of loan terms, sometimes even full denial, all because of one invisible line item most investors underestimated. Now here's the psychological trap inside all of this. Most investors don't kill deals when numbers stop making sense. They justify them. You'll hear thoughts like, "It's still a good area. I can make it work with better management. Insurance might come down next year." This is where psychology overrides math. Because once you've already invested time, analysis, emotional energy into a deal, walking away feels like loss. So instead, investors compress their expectations. They accept lower returns. They stretch risk. And over time, portfolios become filled with almost good deals instead of strong ones. That's the quiet danger nobody talks about. Let's zoom out again. Across the market right now, insurance volatility is doing something subtle but powerful. It's separating disciplined investors from emotional ones. Disciplined investors treat insurance like a core variable, just like interest rates. Emotional investors treat it like a fixed utility bill. One group adapts early, the other reacts late. And in real estate, timing matters more than almost anything else. There's another hidden layer here too. Climate risk mapping and claim data analytics have become far more aggressive in underwriting. That means two identical properties on the same street can receive completely different insurance pricing based on micro-risk exposure models. One side of the street might flood differently. One roof age difference might matter more than expected. Even proximity to fire zones or storm paths is now weighted heavily. So investors can no longer rely on average neighborhood assumptions. Insurance is now hyper-specific, almost surgical, and that changes how deals must be evaluated from day one. Smart investors are now doing something different. Before even making an offer, they are pulling preliminary insurance quotes, running worst-case premium scenarios, building cash flow models with inflated insurance assumptions, and stress testing returns under high-cost environments, because they understand something simple but powerful. If a deal only works under perfect conditions, it doesn't really work. And this is where the market is heading. Not just higher costs, but more uncertainty in operating expenses. Which means one thing clearly: the margin for error is shrinking. Slowly, quietly, but consistently. And the investors who ignore this shift will feel it later in refinancing problems, cash flow compression, and stalled portfolio growth. So what's the real takeaway here? Insurance isn't just a background cost anymore. It's a deal filter. It decides which investments survive underwriting and which ones die quietly before closing. And the biggest mistake you can make right now is assuming yesterday's numbers still apply to today's risk environment. They don't. Not even close. If you're serious about real estate investing, this is the shift you need to internalize. Stop underwriting based on hope. Start underwriting based on stress-tested reality. Because in this market, deals don't fail loudly anymore. They fail on paper before they even begin. If this breakdown made sense to you and you want more real-world investor psychology, hidden risk breakdowns, and market shifts most people miss, make sure to stay tuned and subscribe. Because the next wave of real estate winners won't be the ones chasing deals. They'll be the ones who understand what silently kills them before they ever close.